Hi. Becky, thanks for joining us. We have just received 3 bills from the Senate, 471, 480, and 217. 471 has sections from all over statute in it. So we're going to start with the sections that you dealt with, even though they might not be good.
Yes, Becky Wasserman, Legislative Counsel. So the sections that I have in this bill have to do with the bond bank, the tip sections, and there's the veggie sunset. So this committee has seen the tip language already and the veggie sunset. I think what is new is the bond bank language. And these are global changes. This can be found in sections 23 through 31, which is making changes throughout the bond bank's enabling statute. So there's a few sort of global changes being made. First, just some cleanup, technical like drafting cleanup. There's also a name change from the municipal bond bank to the Vermont bond bank. That's made throughout this section. And then the substantive change that's being made here is that sort of expanding the scope of the bond, what the bond bank can do in terms of the type of financing arrangements that they can make. So in addition to issuing bonds, they were looking for some flexibility for entering into other kinds of financing arrangements. And the reason behind this was that they received some IIJA, some federal funds that they could give out to municipalities for energy efficiency projects. And so this would allow them to get that money out to municipalities easier than through issuing bonds. So I can go through these changes. So section 23 is just making that name change that I mentioned from changing the name of the chapter from the municipal bond bank to the Vermont bond bank. Section 24 is the definition section of the bond bank statute. And so, again, making that change from municipal bond bank to Vermont bond bank. And then this is where the substantive change you'll see in the...
This was all requested by the bond.
Yes, this language all comes from the bond bank. So they have added in language here, and this is sort of the similar language you will see throughout, that expands the definition of bond that they can lend to mean another kind of financing arrangement of a governmental unit, including a bond note or evidence of debt. And this is, again, that same change is made in a couple different of the definition sections here. And the section 25 is, again, just that change from Vermont Municipal Bond Bank to Vermont Bond Bank. Section 26, same thing, the name change. Section 27, this is where the statute is a statutory section that has the powers granted to the bond bank. So this is where you'll see that change that says that they can establish terms and provisions with respect to any loan to governmental units through the purchase of municipal or revenue bonds. And that can include issuing bonds, other forms of indebtedness, or other financing obligations or arrangements. And this additional language that they have about the type of projects, I think speaks to what they are trying to get the money out for to municipalities. So what's added here is climate adaptation and projects that otherwise result in the reduction of greenhouse gas emissions. Okay. Section 28, this deals with a situation where there's a default of a governmental unit. It's mostly just making the statute consistent for this other type of lending arrangement. So it's just making a distinction between non-payment of financing arrangement that was issued by the bond bank and making a distinction between the bonds that have are supported by the full faith and credit of the municipality with these new types of financing arrangements that don't have that, that are not general obligation bonds that are supported by the full faith and credit of the municipality. And so because they're now going to be making those different kinds of financing arrangements, they needed to update this waiver provision to reflect that they have two different kinds of financing arrangements. And then the bond bank in section 29, they have their own general fund that has money to go into it to be used for the payment of principal or interest on the bonds that they issue. And this is just updating their general fund language to say that any money in the fund can also be used to make loans to governmental units under this chapter. So that's capturing these new types of financing structures. And then a similar change is being made in section 30 with their revenue fund section. So this will also allow them to use the money in that fund for to money to go into that fund for repayment of loans that are made by the bank that are not bonds. And then section 31 is just updating their enforcement section to add in sort of what happens for situations where loans that are made to governmental units that are not their typical types of bonds and municipal bonds and revenue bonds. So that covers the bond bank sections. Yeah.
Just to hold for a second on that.
Sure.
The appointed and enforcement of this title may and shall, trustees name upon written.
So this change up here on lines 13 to 14 are making the language gender neutral.
Okay, I got it. Thanks.
Section 32 of the bill is a change to what was in.
Sorry, one second. No one has any other questions about the bond bank. Everyone's good with the bond bank.
Yeah, I mean, I just want to say,
Okay.
this is something I talked with the bond bank about earlier. I'm really pleased to see it in here. I think creating this flexibility, especially around the climate resilient infrastructure language, this is good. I'm glad to see it here.
Good, I'm glad. And it wasn't in the original one because the bond bank sort of realized that they needed this in the context of IIJA money after this bill had already left this committee. But they did reach out to me and I met with them and Senator Cummings simultaneously.
So I have not spoken with the bond bank.
Yes.
So this is all new to me.
Yes.
We have a side-by-side?
Yes, we will Abby will do the side by side at the end.
There is one that is available.
Is this being on the floor tomorrow?
Yes, but I'm happy to report it too. Okay, we can figure that out
Let
later.
me see how, we
Yeah,
will,
well, yes.
I mean, I wanna do it, I
Yes.
just
Yeah.
need the info. This is all new to me, I wish Bud Arman was here. But anyway, go ahead, I'll figure it out.
Section 32 is a change to the study of financing public infrastructure improvements that came out of S94 in this committee. So as it came out of this committee, it was a task force that was going to be doing, looking at different ways to finance public infrastructure improvements. And this has been changed to a report that will be done by the Joint Fiscal Office and come back to this committee and the Senate Committee on Finance in January of next year. That is just generally looking at financing public infrastructure improvements in Vermont municipalities. The report would include a few things, and some of this comes from the language that was in S94. A review of public infrastructure financing programs in other states and municipalities that may be implemented in Vermont, recommendations for aligning state and federal assistance for public infrastructure, and recommendations for harmonizing or expanding existing infrastructure improvement programs and distribution of funding. The Joint Fiscal Office in subsection B can submit this report to the committees in the form of an issue brief, or they are authorized to hire a consultant to perform the research and draft the report. And if they do hire a consultant, they can use up to $50,000 for the costs from legislative funds. And I think this was in part changed to due to some concerns from the Joint Fiscal Office of the other language would require a workload that
They weren't able to sustain this.
Yes.
Yes.
So it has to make a stop at approach?
This is from the legislative budget, so I think it's
Okay, so
saying it's
okay.
not appropriating
Got it.
money. That being said, I don't know if that does have to go to appropriate, but it's not an appropriation. Okay, so the tip sections, you've seen this language. Section 33 is making the changes to the use of debt proceeds for funding debt service interest payments for a period of up to 2 years. It is also changing the definition of financing to allow for the use of bond anticipation notes. This is on page 31. That can be used as a method of financing, and those won't count towards a district's first incurrence of debt. Section 34 is amending statute to deal with language on page 32, the boundaries of a district. So this is saying that you can't adjust the boundary lines of a district after the approval of a TIF district plan.
Just take you back, there was language in the section about using bond anticipation notes. I thought it said that ignoring that period could not be more than 2 years, and that 2 years did not start the debt clock.
The 2 years was for the use of debt service interest payments. You could do
Okay.
for 2 years. So you could, during that time period in which.
But I thought that's what you did in the 2 years was bond anticipation notes.
That is one, I mean, not all municipalities will do that,
Okay.
but they could use a bond anticipation
Okay.
note. But this is saying that that is actually not your first incurrence of debt, so the clock doesn't start running on.
As long as that's still there. Thanks.
So section 34 was the boundary lines of a TIF district, so that there would be no adjustments to those boundary lines. Section 35 deals with the situation of decrement when the assessed value of the property decreases in comparison to the original taxable value of the property. And it says that even if there's a decrease in the value of the property, the municipality, I'm just getting to the language here, the municipality still has to remit not less than that aggregate tax due on the original taxable value to the ed fund every year.
Can go up, but it doesn't go down.
Right. Section 36 deals with a situation of a municipality that has a tax stabilization agreement as well as a TIF district. And it says, just go into the language again, if you have both of those situations, your increment is calculated based on the assessed value of the property in the municipality's grand list and not the stabilized value.
Is there anything in this TIF language that wasn't in the original?
Nope, this is all, and this is the emergency TIF language here, it's just striking out. And then there was some language that was in S94 that is not in here, but nothing like, all the language in here on TIFs is all language you've seen. I will note two things though that are slightly different is that for the Barry extension and the Hartford extension, they changed the date that they can retain increment. In the version that came out of your bill, it was December 31st of the year, and they changed it in both instances to June 30th. So, and to align with their fiscal years. So that's actually giving giving them less time to retain increment.
Becky, can we go back to section 36?
Sure.
Page 34, line, well, it starts at line 5. This is just codifying language.
This is putting in statute that if you have a tax stabilization agreement, a municipality has a tax stabilization agreement and a TIF district, they have to calculate their increment based on the assessed value in the municipality's grand list and not on the stabilized value.
It's policy now, this is just putting it in statute.
I think this, I'm not sure why this came up. I think actually it came up in the context of Montpelier a few years ago when they were thinking of doing when they were first thinking of doing a TIF district. So I don't know what the policy has been. I just know it came up in that context. And so I don't know what other districts this could possibly impact right now.
We have a municipality somewhere that this is for, that's right now.
Yeah, so this language has been out here for a few years, and my recollection was that it originally came because of the Montpelier, but I don't know. I think right now there might be another district that it impacts, but
And I feel like district or not, it makes like a huge amount of basic common sense to.
Yeah, I mean,
Tips are confusing.
Yeah.
it's just saying that you can't calculate the increment on like the lower value. You have to do it on the assessed value of the property.
And I feel like all of these paragraphs or sections are all like, because it was confusing once for one particular district, but I think the need for clarity is true no matter what district we're talking about.
And part of that arose from a request by the auditor for clarity, for sure.
Yes.
And I was saying homeless, it was all this done several years back.
That is one place that is.
And then maybe another place, as you said, and the auditor said, putting this straightforward language in black and white is everybody's benefit.
And I think it's sort of better to not personalize it to each place that might get confused.
Sí, señora, señorita, whatever.
Becky.
So then the section 37 is the Barry extension and section 38 is the Hartford extension. And so the only changes there from what was in S94 is just that moving the date up for
To June.
to June. And then the final piece is the veggie sunset, which this was the same language in your bill as a 1-year extension.
Thank you very much. Anything else for Becky or Rona?
So this is pulling in stuff from S94 into this bill, so we won't see it. Was there any discussion about that? Come up with something other than the TIFs? And is there?
There's a report in here.
Yeah, the public financing
JFO.
infrastructure improvement study is, so that was changed from S94 to be a task force to a JFO report.
And the rest of the veggie language, my understanding is that Ed and Economic Development felt that they didn't have enough time to wrestle with it, which is why we have sort of another year something, so that Commerce can continue talking about it.
Becky, the side by side, I found it on our, does that say the fiscal impact of these changes?
It does not. I don't know if there's a fiscal note that JFO has done.
There is, the original 94 had it, and the impact arises from moving the date for Barry and Hartford.
And we'll hear from JFO
Yeah.
when we're done. And Abby's gonna still come up and tell us more things about the bill that she found for you. Anything else, Becky? Thank you very much.
Abby coming up is her computer.
I think so. Yeah, yes. Let's do all attorneys and then fiscal staff. Oh, but you have to go.
I will be running in 3 minutes, but I haven't changed, so I don't know.
If you want to try to go now, that's fine with us.
Can I go now?
Yeah, that's fine.
Great.
So they have the time when you cross the start line, so.
Yeah, that's.
Becky, we're depending on you to carry our.
Yeah, this is actually, this is our team right here.
We got the whole team, oh, well.
Okay.
Seems like it basically divided.
So I will make a terrible pun just because I feel like it. I will try and do this as a speed run.
Pretty lame.
Pretty late, yes.
Instead of a walkthrough?
That was the idea.
Yes. This is a draft. So this is kind of a preview of the fiscal note. It's really a collection, as Representative Anthony mentioned, of different fiscal notes from different places. So sections 1 through 6, these are all pieces from H471 as it came out of the House. These are all no impact de minimis changes to various tax statutes. Section 8 is a provision that would extend the sales.
Can you make it a little bit bigger for our eyes?
Yes. Let's see if I can move.
You have a slider on the bottom right.
Oh, I do. Very cool. That is too big.
There you go.
Oh.
So section 8 extends the sales tax exemption on advanced wood boilers for 1 year. This in S93 was estimated as a de minimis sales tax expenditure of between $36,000 and $60,000 per year. That is a cost of the education fund. Going back to language that was in H471 for sections 10 through 14, these are de minimis changes to various funds for certain tax provisions that you'll hear about from Abby. Sections 15 through 17 would allow those without a social security number and eligible for the EITC and child tax credit to receive those credits. That was in S56. And that was estimated as a de minimis cost just because of the number of people who would be eligible through this provision. Let's see. So section 18 allows for advance payments. That is, cost. Sections 19 and 20 are a technical change in the reference to the composite rate from the middle rate to the second highest. That is technical. You'll hear more about it. Section 21 was in H471, and that was a existing $250,000 tax expenditure for allowing, it extends the property tax exemption for qualified rent restricted units every 10 years if the HFA finds that the property meets certain exemption requirements. The bond bank statute, where we see this as a change that these changes do not have any fiscal impact. Section 32, there is a permitted cost of up to $50,000 for legislative funds. This would come out of the budget of the General Assembly. Starting in section 33, we're now into TIF provisions. These were all in the fiscal note for S94. And they were all registered as de minimis changes to or costs to the education fund or benefits if you're kind of protecting the boundaries of a TIF district and not allowing them to expand, right? You're minimizing the potential cost to the ed fund. However, the extension of debt retention periods do have a cost in the 2030s. So for the city of Barrie, the extension of the district debt retention period from 2034, this should be 2034 to 2039, that's why it's a draft, would be an tax expenditure of $275,000 to $290,000 per year between 2034 and 2039. And then the town of Hartford debt retention period extension is a tax expenditure of $650,000 in those. It works out to be 2 calendar years. Section 39 extends the sunset of veggie by 1 year. That would extend an existing annual tax expenditure of between $2.5 to $4 million per year. And this bill also has a provision that sets the workers' compensation rate at in fiscal 24. It keeps it the same as it was in fiscal year 23. And so there's no change in fiscal year 2024 special fund revenue for the workers. comp administration fund.
And 1039, the veggie, that dollar value is for newly granted because the other ones already in existence would have already have been, if you like, accounted for.
This is taking the cost of the program per year, so this is the average amount of.
Every year that's lost. Okay.
Exactly right.
Both
Yep.
existing and any new ones that are entered into.
Yes.
Got it.
I really like this format. I know it's a draft, but it's helpful. Yeah, it's like so straightforward.
Great. Yes, I'll keep it that way. Yes.
Okay. Any other questions? I hope you win.
Great. I wasn't planning on finishing quickly anyway.
It's not Thanks.
All right. Yes. Thank you. Appreciate it.
Run for Damien.
I will. Yes. We will. Yes.
And in the suit.
We'll think of you. Yes.
Abby? Hello.
Sorry, I got bumped off of the Zoom, so I'm just jumping back.
You know your mom is Katie. She wants to get matters.
No, I know, she's coming in too.
Oh, yeah. There we go.
Great. So for the record, Abby Shepherd, Office of Legislative Counsel. There are a bunch of different documents under my name. There's H471 that we've been reviewing. There's also H480. I will wait to walk you through that. It does say H471 is passed by Senate. That's the language currently. That is everything that the Senate just voted on, but the way you see it, because it hasn't gone through the whole drafting process, it says an amendment from Senator Cummings, but that is the entirety of the language. It was a strike all, so you see everything in there. Would you like me to walk through that or the side-by-side, which is also available on the committee webpage? What's easier?
I would prefer the side by side.
Side by side, sure.
Would anyone prefer the language? No?
I can flip back and forth. I have it all up. That's
Yeah, let's do the side by side.
okay. Great. Thank you, Saoirse. So again, it is still labeled as the Senator Cummings strike all because it just hasn't been processed yet by drafting operations to have all of the, and I haven't had time to update this. Okay, so you'll see on the left-hand side of this chart, you have as passed by the House. In the middle, you have the Senate Finance Proposal of Amendments. I apologize, this is all sort of squished together. There was a committee amendment and then the strike all. But I will.
You're just showing us the strike all in the.
Yes, the strike all is really all, which is the furthest right. So what passed out of the House was the annual link up, both for the income tax statutes and for estate tax. That is unchanged. There were two different changes relating to the taxation of alcoholic beverages. That's for the takeout containers. So it's clarifying in both sales tax and then in meals and rooms tax that those sales, when they're in closed sealed containers, are subject to sales tax. So they're being consumed off premises. And that was following the takeout of alcoholic beverages expansion through the pandemic. And then there's some technical changes to align with alcoholic beverages definitions. So that is all unchanged. The next two sections are also unchanged. They relate to refunds for meals and rooms tax. Okay. Unchanged.
Yeah.
Great.
Something new.
Something new. Oop, I'm sorry, too fast. There is, and what passed out of the Senate, there is now a report being required from the Department of Taxes on ensuring that purchasers are aware that a vendor or an operator or a restaurant may have been overcharging. And it's a report about when would purchasers be notified that there were overcharging, there were any overcollections of tax, and what would be the notices that would be required of a vendor or operator.
It's all in the context of the zip codes and the local option tax.
Partly, yes. That is part of what prompted this, was how do purchasers know that they can request a refund, and what is the onus being put on the operators who are collecting the tax to actually let purchasers know that they can either directly get a refund from the department or you ask the seller for a refund. So that would be due next January.
Everyone remember the amazing medical zip codes and Rebecca Samaras somewhat You guys have a presentation for us?
Yep.
End of the year, just we're gonna do a year in review, that presentation is top of the list for me, okay?
So seems like it's broader, but it's got a
It
long
does.
list of.
Yes.
Would you like me just to pull up the language so you can see? Sorry, is there?
Yes, no, we're good, we're good.
That's fine. Just another report.
Okay, yes, another, they were, part of
Taxes
the
we're writing.
discussion.
But doesn't have to write it, so that's fine. For tax.
The next section is a slightly different version of what was passed out of the Senate as S93 that was briefly in your committee. It's extending a sunset for a sales tax exemption for advanced wood boilers. This language extends it for 1 year. So it was set to sunset this July, and it would be sunsetting instead next year.
And I mentioned this morning, was that this morning? I think this is in a few other bills that we might see as well.
It is also in the miscellaneous agriculture bill.
But it's not in the
Identical.
miscellaneous environmental bill, I know.
No,
Okay,
it's not. Only 2 votes.
Why would it be till July 1 as opposed to June 30? If you're in the fiscal year?
It sunsets on July 1st.
Okay.
The effective date is
Exemption.
extending it June 30th, but that's when we typically have. It will no longer be in effect on July 30th, but July 1st. So June 30th will be the last day that it would,
Okay.
somebody could benefit from it. If there are no other changes, I'll just breeze through. Cap tap was unchanged. The 2 current use provisions, so notices and the land use change tax change, those are unchanged in the Senate. There was 1 change made to the property transfer tax exemption, which was enacted for nonprofits that are related to mirror what C corporations and some pass-throughs can take where they have either a dissolution or a change of membership or ownership. So that was passed out with a holding period. So if you remember, the first transfer was exempt, but if the nonprofit that received the property turned around and sold it within 5 years, that first transfer would become taxable. The Senate changed the holding period to 3 years and made some clarifying changes to make it clear that it's taxable if the commissioner determines that there was an intent to avoid taxation.
Was that a request from the tax?
They initially requested the exemption be included so that nonprofits could have similar treatment, and then you had passed it out in the same version as what they had requested, but the Senate just shortened the holding period.
Okay.
Next, getting into personal income tax credits. As passed out of the House, there was just the change to the child and dependent care credit. What's added in here is language you've seen that was in your amendment was going on to S56. So that's relating to the earned income tax credit, where it expands the credit so that individuals without tax ID numbers could claim the credit. It also amends some phase out language. That was the initial request from the tax department, was to make some technical changes. The child tax credit is also expanded so that individuals without social security numbers or tax ID numbers can claim the credit. It requires the Commissioner of Taxes to set up a process for individuals without tax ID numbers to claim the credit. And it does require all of that information to be kept confidential. And then if you'll recall, there's also for the child tax credit, contingent language that would make advance quarterly payments of the child tax credit take effect only when there's federal action, to ensure that reoccurring payments won't be part of benefit determinations, that won't reduce anyone's SNAP or other payments.
Is this in our version of 417?
No, it was 471, do you mean?
50, sorry.
It was in S56, so I have been in here talking about this recently, but in a different bill.
Okay,
Yes.
so now
So it's identical to that.
417,
471.
71, why am I keep saying that? Okay, so now, phew, okay,
Hopscotch.
yes. Is the rest of the childcare bill stuff in here too?
No,
Just this one?
just these pieces relating to EITC and child tax credit for the tax ID numbers only. It does not have the split of the EITC that you've seen in the S56 language.
And it was
Bless you.
the minimum fiscal impact.
nodding, but I defer to JFO, as I believe you just heard from. Ted, that is correct.
Yes.
You're not Ted, but you agree with it, yes?
Yes.
Great.
Okay. The next change is new and, oops, I'm sorry. This was actually my recommendation for a technical change because I had realized during the S45 salt deduction workaround discussions that some statute was never changed following the Tax Cuts and Jobs Act. Vermont, we used to have 5 personal income tax rates. The top 2 were collapsed. So there's no longer a middle rate. The way that pass-throughs, when they have non-resident members pay, they file as an entity and they pay for their non-residents. They pay at what is really the second highest rate. This would make that change in statute to line up with current practice and what was the rate prior to the tax reform after Tax Cuts and Jobs Act. So it's really a technical fix, but it does need to be in a policy bill because it's a tax change. So that is in the as passed Senate version. There was the salt deduction cap workaround in one version of the Senate bill. It was never in your House version of this bill. You had seen it in the S50 language. The salt deduction cap workaround is not in what the Senate just voted out of the miscellaneous tax bill.
Is it anywhere?
In anything that is moving, to my knowledge, no. So it was in the S56 language, it was in this, but that's no longer.
There. Still available for next year.
It is on the wall.
So this section 12, D, E, and F?
Is that all? Yes.
Yeah, deletes from the bill, all right. All right, good, thank you.
Do you know the reasoning as to why they stripped that out?
It was in the committee proposal, and then in the individual amendment that replaced that, it was removed.
Okay.
That's in our side.
I thought the
Question
governor
for
wanted it, I thought this committee wanted it, we had it in something at least, and I thought the Senate wanted it.
It was in there when I looked at the bill this
I asked them to take it out
and
after a conversation with Chair Marcotte. Because if we don't concur with this bill, it doesn't have any more runway. And so I tried to help them narrow it before they voted it out so that we could get it across the finish line.
I'm sorry, I don't understand what you just said about the runway.
We don't have any time left in the session, and so we wanted to have a bill that we could concur with.
Why couldn't we have?
Because I had a conversation with Chair Marcotte about the veggie changes and this longstanding, he has concerns about the salt workaround and so we had to take it out.
Is there any other place we could put it on a?
I don't think this year.
That's very disappointing.
Free money.
How many millions of dollars are Vermont taxpayers going to pay?
It'll be like an expenditure for taxpayers.
Federal expenditure.
Yeah, about
Yeah.
20
And
million, 18 to 20 million.
I don't
And loss
understand
of
what
revenue.
I don't understand what veggie has to do with this.
So, the Commerce Committee spent a huge amount of time on veggie this year and on all of that language that came over in H10, which was sort of melded in there and then didn't make it through. And so in talking to the chair about their disappointments about veggie and the salt thing, and we were.
So is now veggie in here?
Veggie's not in here, there's a
Salt's been taken out?
there's a sunset change, but all of the policy work that his committee did on veggie is not here.
So because I need this spelled out, I just don't get the veggie connection.
They weren't ready for salt in this context.
Who's they?
The Commerce Committee. And we had it in a very different context when we sent it over, because it was to offer a huge income tax increase, which is not what this bill is. This is a miscellaneous administrative changes bill.
I just I think where Carol's trying to get to, I don't understand the reasoning behind the connection with veggie and the salt workaround when we're gonna lose money to the state and also lose a credit at the federal level for these income tax filers. Like the tax commissioner said, it's free lunch. What?
He keeps on saying the free lunch thing to me, and it's funny that.
Yeah, I'm gonna use it. It's
Remarkable how good that one is. I like.
ingrained in me, but I just,
TC for rich people. I think that's a fun version of it, but whatever.
we can call it what we want, but I just don't see a connection between why commerce in veggie would be against or need to remove the salt tax.
It was more just like various committees and obsession pieces that were all sort of locked up in Senate Finance.
That's
But a chapter is set up,
I hear that everyone is,
it's an empty box.
but
You're gonna add a new chapter or subchapter 16C, but it doesn't have any
there's no.
operational content.
Right, I was
Sorry, so just, I haven't had time to update this, but the middle column was what one version coming out of Senate Finance would have done.
Mm-hmm.
That is not what passed out. When
Okay.
it says Senate Cummings strike all, that's what just passed out of the Senate.
Right.
So that there is
So all
no
three,
chapter,
all-
subchapter 10.
They're all gone.
was
Okay, I thought it was just the middle one. Never mind, okay.
And our committee had voted to include this in
We did.
F6, which is no longer moving, and it did not get added to 217. But I mean, this is something that our committee had voted for before, for the reasons of the opportunity to provide a federal tax credit while also raising 1.7 million per year in state revenue.
Oh yeah, that went up because we reduced the,
We went to 87.
yeah, that's right, so it's even more.
Yep.
It's not the 800,000.
1.5 million to us
Yeah.
instead of 8 or 6.
Well, that's really disappointing, and I don't know if we have a vehicle to tack it on, getting back over to the Senate before. I doubt it.
There are no minutes left for anything.
Can you explain that? Like, what would happen if we amended miscellaneous tax?
It wouldn't, I don't think it would be able to get to the finish line because there's it has to pass. So like if it was a different bill, it'd be okay to just like lay the numbers on it. It's not the expression.
About 217.
217 is deeply unamendable.
Because we couldn't suspend rules and message action.
Well, the timing would still need to work for them to be able to concur, for them to, right now, if we concur, then they don't need to then act again. Right now, they would need to have time to act. But we don't have to, nothing's gonna happen until the floor tomorrow, so let's finish going through this and everyone can do their thinking.
Are we going to approve this tonight?
We could do it tomorrow if we need to. I just wanna make sure that we can get through all of it. We still have 2 more bills. And I would like to leave this room eventually, and I imagine other people would as well. But we can hold on voting on it until tomorrow morning. There's nothing there's no action that needs to be taken before tomorrow 10, so.
The next section is the VHFA certificate renewal that was unchanged. There was a deletion from the bill. You had 2 different property tax credit related proposals that came over from the Vermont Legal Aid. The first is what was deleted, and that required the commissioner of taxes. Well, currently the commissioner needs to provide notices to towns about what the property tax credit is. And under current statute, towns are required to include that in homestead property tax mailings unless they find that it's too big or doesn't fit within the envelopes that they use to send property tax bills and delinquency notices. The House version struck that sort of if the envelope's too small, it doesn't fit, that exception no longer existed. And it required all towns to send out plain language notices so that it would, in theory, increase uptake of the property tax credit and provide more information about the property tax credit. There is also a property tax backer, and I don't know if I should be speaking to hearsay, speaking to something that the tax department said that they have already done, if that's in order. The tax department did say in Senate Finance on this particular section that they have updated the back of the property tax notice, the backer, that they are providing already to towns. So you might want to hear more from them about what that looks like now. That does already have an explanation of what the property tax credit is. So that's providing the intent for deleting this notice going to towns. The section 14 is removed from the bill. Section 15 is retained. So there's no change there, which extends the deadline for claiming a property tax credit. As you just heard from Becky Wasserman, the bond bank language, I won't walk you through that. The rest was what she just walked you through, and then my colleague Damian Leonard will be able to walk you through the remainder unless you have any questions about effective dates. Other than some contingency for the child tax credit, but I think you're all well aware of that if there were advance payments. Okay. Jamie, do you want to share your screen or do you want to? Okay.
Great. For the record, Damian Leonard, Legislative Counsel. As Senator Cummings described this is the belts and suspenders aspect of this bill. You are going to hear me talk about these sections twice tonight because they are in both 217 and 471. The first is the workers' compensation rate of contribution for the administrative fund. This is the surcharge on workers' comp premiums that we set every year. It's remaining the same as last year at 1.5% on direct calendar year premiums and 1% of self-insured losses. So we talked about this a few weeks back or actually probably about 2 months back when H217 left the House. This raises money for the workers' comp program, so that's why you're seeing it in two bills. It is a must-pass provision because otherwise we have an unfunded program. 33 is an ironic provision that was in 217, and it's designed to provide insurance for when the workers' comp administrative fund gets put in a bill that has controversial provisions in it. So it basically defaults us to last year's tax rate if the bill doesn't make it across the line. So again, this is, as evidenced by this year and previous years, this is another provision which the department is asking us to pass and would like us to consider as a must-pass provision so that they feel more secure in their funding stream. The next two sections are the first one is a sunset that everyone is in agreement on, and it's actually amending a sunset so it makes the language that's been in a now 8-year trial period permanent. So it's a 14-day continuance when you get a notice from the workers' comp insurer that your benefits are about to be discontinued. If you think that's an error, you're allowed to, this allows you to request an additional 2 weeks, put together documentation from a doctor showing that you haven't reached the end of your recovery or something like that. So this was a non-controversial section that was in the bill as it left the House and that the Senate kept in. Both employees and insurers are in agreement on keeping this language. The last section is a technical correction to the sunset for an increase in unemployment insurance benefits. And I know it's not a taxation provision, but it does affect the taxes paid by employers because of the way the tax rate is tied to the balance in the UI trust fund. And because of the way I wrote it, the language contained an arithmetic error that would have had us overspend by somewhere in the range of $2 to $10 million, depending on timing. So I am too. So we can thank Cameron Wood from the Department of Labor for thinking through the language and getting in touch with me and Representative Marcotte last June to point out the issue and get things moving. So that's that. Everything there takes effect, I think, on passage. So any questions? And I promise I'll just tell you, we already talked about those sections when we get to them in 217. So. Great.
Thanks.
You folks want to wait on this bill until tomorrow morning?
Which one's this, 217?
Miscellaneous tax. On straw poll until tomorrow, or do you want to straw poll now?
Wait till tomorrow.
Okay. Can we do whatever the other next one is? 3.
Again, would you like to see this side by side? Is that helpful?
Yes.
Or I think the language might be a little challenging to scroll.
And actually, Abby, I'm sorry, Katie, would you prefer we did 217? That's up to you. You sure? Elliot? Excuse me. Let's do 217 first. I'm sorry. Yeah. I'm sorry, I was just following the agenda. So that's mostly Damien. I don't think we need it. So I would. Did he just walk out of the room? He did. Yeah. Oh, okay.
He ran.
So committee, we have seen the bulk of the policy language in 217 before. I would rather we not rehash every conversation we've had 50 times. There are some small tweaks there. The responsibility of the Human Services Committee, not ours. They're also hearing on this. I would rather we just focus on the new revenue package.
Yep.
Is that okay with everyone?
Yeah, absolutely.
Okay, I just don't know if I can share it. So you have bored and guy drafting it 5,000 times, and I appreciate that so much, Katie. If anyone wants to try to fix that window and open it, that would be great. Feel free to be handy.
I don't think that one will.
It's okay. So no one needs to go through the policy language.
No, there's been a change.
There have been some changes. Do you want to just show us the changes? Sure. Is that helpful? Okay. Are you able to, you have them tracked enough to do that?
See.
Okay. Cool. Nolan, thank you.
I did it for me.
You committed it, so yeah.
Katie McLean, Office of Legislative Counsel. So this is H217 that passed on the Senate floor today. Most of the language you've already seen. There's an extra member on the Pre-K Education Implementation Committee. So that is a change. We're also, there weren't really any other changes in the pre-K language. There's also, there was an inflator in the provider
provider reimbursement, ongoing inflator, that was removed. And instead there is a report that asks for information on how the inflation and the rate should be calculated moving forward, and specifically what the rate should be in fiscal years 25 and 26. And then when it left this committee, I believe the family copay was $26 a week. And this version has the family copay at $25 a week. So those are the big policy differences. If you want to look at the language, I can show that to you, or if you're more interested to get to the revenue, that's okay.
But really, if anyone doesn't, I want you to feel like you're the person that's holding it up. I just don't want to have us do it all.
Okay.
Okay. Thank you, Katie.
Mm-hmm.
Really appreciate it.
Do you want me to stick around?
I don't. I think what we can do is that if something comes up that we have a question about, we can check on you in the morning.
Okay.
Okay.
Okay, very good. Thank you.
So Damien's gonna have to color by himself, and that would be a really big job. Damien, do you want to tell us about the revenue? Or will you, whether you want to, I guess?
I don't have a choice, do I? Right. Great to see everyone again. It's been so long. Okay. Do you want to start with payroll tax?
That's how it was.
Right.
Probably not, but that's why we are.
All right, so this is being called the child care contribution now. It's basically a contribution set up to fund the CCFAP program.
Damien, I'm sorry, can you see what page you're on, because I can't see
Oh,
it.
I'm sorry. Yes, 36. Sorry about that.
That's good.
Wow. All right. So this is a payroll tax set up in Title 32. It's directed to fund CCFAP. It covers all wages paid to an employee. You'll notice in here that in the hurry of drafting this, we have a definition of both covered wages and wages. That's because earlier versions of the Senate version of this earlier had covered wages as up to $160,200 or $400, the Social Security contribution and benefit base. That was taken out in this version. So it covers all wages. Legally, it makes no difference that we have a covered wages definition. It's just sloppy drafting on my part, so I apologize for that. The employees are anyone who gets paid W-2 income. Employers are anyone who pays out W-2 income to employees. Self-employed individuals is self-explanatory. Sole props, partners, LLC members, and shareholders in a corporation. And so self-employment income is as defined under in the U.S. tax code, and wages also as defined in the U.S. tax code. So we're using federal definitions because in Vermont, we track the federal definitions for purposes of our taxes. The contribution rate, so contributions are collected in the same way that income tax is collected. So it's quarterly basis for employers to pay the payroll tax to the Department of Taxes. And then again, quarterly estimated payments from self-employed individuals. The contribution rate is 0.44% on covered wages, and that is split 75% to the employer, 25% to the employee. And then to mirror the employee contribution, self-employed individuals pay 0.25%. Or I'm sorry, 0.11%, which is 25% of the full amount. The this language in here is just applying the standard income tax collection provisions to this for enforcement and so forth. And then we create a special fund where the revenues will be deposited, and this dedicates the expenditure of the revenues to CCFAP administering the fund and administering the collection of the taxes by the Department of Taxes. The next section establishes 15 new permanent positions at the Department of Taxes. This is what the commissioner testified that the department would need. They're being established in FY24. My understanding is that the majority of them will be hired close to the end of FY24 because the tax becomes effective in FY25. What's that?
Do people stay while they're running the corporate cup? Is that part of it?
I don't know. I've never run it.
You always miss finish for something.
DJ.
Do you always miss it?
Well, this was the first year where I was like, oh, I've had a couple of years where I was available. Maybe I'll try to enter. And here we are. So it's okay. It's okay. It wouldn't have been a very pleasant run for me anyway. So let's just leave it there.
Your family's still out there waiting?
No, they I don't know what they're doing, but they're not waiting for me. They know I'm stuck. So my kids don't remember who I am. Anyway, the majority of the new hires are 10 tax examiners, and then the rest are compliance and financial business analysts for the department. And then that would bring us, there's a $4.2 million appropriation to implement the new contribution. This is for IT costs and developing the procedures and other things necessary to implement, as well as the cost of paying the staff who will be on board during FY24. And that brings us to workers' comp and unemployment insurance. How much do you guys want to hear about that? You've already heard about the tax provisions.
And have we already actually had this part built in our committee?
You have had some of it. So what happened in the Senate is that they married H217 to H92. And then they added S101 to it. So S101 primarily relates to so you've had the provisions in here where we're expanding so the workers' comp tax rate and then expanding unemployment insurance to small nonprofits with fewer than 4 employees. And the rest of the unemployment insurance provisions. What the Senate added to this were a number of sort of workers' comp policy changes. So they're not going to affect the tax rate, but they will do things like correct issues with the way benefits are paid out to lower wage workers, where there's a financial disincentive to go back to work because of a glitch in the benefit formula that pays them less when they take back on part-time work than they would have gotten if they were on full disability. It also increases the dependent benefit for a trial period of 3 years, and then has a number of other procedural corrections and clarifications in the statute that were asked for and then negotiated heavily between workers' advocates and the representatives of the insurance companies. So, most of this we spent a lot of time on this downstairs in House Commerce. Not sure how much you guys want to hear at 6:45 at night.
No.
Okay. It's really exciting stuff, guys.
It is. It's really good stuff.
But okay, I think that's it.
Okay.
Thank you for your time.
Thank you.
Do you want me to stick around?
Yeah, I do.
Okay, that's fine.
Pat. Hi.
So for anyone who can't tell because of my disguise, I am Patrick Titterton. I joined fiscal office. Yeah, my upper lip was still cold, but my chin was warm. So I guess I would be curious to know which particular pieces you're interested in hearing. For fiscal year 25, so I guess I'll back up. Damien just ran you through the effective date for the payroll tax. That'll start being collected July 1 of 2024. And so in that first year, we're estimating that there will be around $82 million in revenue raised from that source. And then looking into the next year, fiscal year 26, when you have a full comp, the whole year is being accounted for. We anticipate that revenue going up to about $92.7 million. And that was sort of calibrated to cover the costs that Nolan and Joyce have been estimating for all of you. And again, as Damien said, that's 25% on employees, 75% on employers. Wage income is taxed at a rate of 0.44%. And then the self-employed income is at a rate of 0.11. That is conveniently about 25%. So 0.11 is conveniently about 0.25% of the 0.44. So if you divide it by 4, you get 0.11. And the reason for that, and I think sort of the thinking there was, well, self-employed income people, they're not having sort of their employer pick up the other portion. So why don't we treat them as if they are the employee in this case? Hence where the rate adjustment came in there.
I'm sorry, could you say again what the employer-employee split was?
25-75. So the employer will withhold sort of 25% of that total contribution from their paycheck each time they get paid. And then they're responsible for remitting their portion and the employee's portion to the tax department to be deposited in the special fund that is created.
Can you show us the chart?
I can show you a chart.
It's very late to any number in the head.
Yeah.
I trust that you can do it.
So this is just to give you a view of what sort of employees or self-employed people at different income levels would be contributing. This accounts for that 25-75 split. So if you're making $25,000 a year, your personal contribution is going to be about $27 for the year. I think that works out to like 50 cents a week. And then the employer obviously is picking up the additional 75%, which is that 82.5 number you see up top. So overall, the contribution on that employee's work in the year would be $110.
Is there in this version of is there a cap on the annual wage income that is subject to?
I'm glad you asked that question because I forgot to mention there is no cap in this version.
On this version.
Yep.
Okay. All right.
So it's on 100% of your earnings.
All right.
Yes, so the chart stops at $500,000, but in the event that somehow you had
W-2 income.
Yeah, so I mean, let's say you made to earn $1 million a year.
In a W-2. Okay, well, guys, one person asks a question at a time.
I don't have the exact figure, but it's a small number, relative to the
Do you have the number?
I don't have the number with me. I'm not sure if the tax department could tell me if they, but I'd have to get it from them.
The chart stops, but
Oh, I could do as many sort of pro forma income levels as we want here. I mean, at $1 million, all you really have to do here is double the numbers you see for 500,000.
It's on flat tax anyway.
Yeah, and if you want to do 5 million, just add a 0 to those numbers.
All right, thank you.
Any other questions?
I see we've written here 100% of the social security maximum and 200%. What is that for?
Yeah, so maybe you recall from our discussion earlier in the year on paid leave, but there have been versions where there is a cap, as Representative Beck was mentioning, where income up to that cap is taxable and anything above it would not be subject to the tax. So the Social Security taxable maximum, when you pay your FICA, your federal government payroll taxes, they go up to this amount. So for tax year 2023, that amount is $160,200. And then in the construct you had for age 66, it was up to 200% or double that. So they're really just kind of guideposts to let you know, to give you a picture of where you've been at in previous discussions this year. But I could have picked anything.
No other questions?
So I was wondering how this might compare to the income tax that we asked for in terms of how much, how it went up, but I can look up the charts.
I could dig up the charts if your chair would like me to.
Carol, do you
No, I'll look them up myself.
Okay, there are a lot of charts. I was looking for charts for the reports and I was like, wow, Kat has done a huge amount of work for us. Thank you very much for the huge
Well,
amount
I
of
know
work.
that you like tables.
Charts, tables,
Anything you want.
fun, what's it called, sawtooth? Sawtooth. Not shark tooth, yes. Anyone need anyone else?
You just want to name that I believe that we had really good policy that was not a flat tax and that took care of almost one of ours in different ways. But I'm glad that we have before us a strong childcare policy bill. That this raises revenue that helps support transformational change.
Here, here.
Care to make it more affordable and more accessible. Such is the end of the session.
I'm really, I feel much better about the payroll tax with no limit. I think it makes it much more progressive. And we spent so much time talking about self-employment in this committee in the context of a childcare bill. So much time. And so I think it seemed apt to make sure that we were, the 25% rather than 100% of self-employment income felt like a really important piece of puzzle there too. So, I also really appreciate the really fun tax exploration we involved on all of the facts in the context of this bill. So thank you for that. Yes.
As much to say, none of this was wasted.
No.
You know, we've got next year, we've got a bunch of stuff, so none of this exercise was wasted.
Just to make sure, so I can tell my constituents, this payroll tax would start on July 1st of 2024. Is that right?
Yeah, July 1, 2024.
That's when it starts. Okay.
I'm looking at him because I don't have the language.
Okay. All right.
Right, thank you. Sorry, I was caught sleeping.
No worries.
And I guess just quickly, the tax part needs about a year to hire the staff
sure,
and get the IT implemented. So there is
Software, all this stuff.
it is bumped out. It wouldn't be July 1st this year. It's
Okay.
Folks like to vote on this now, or do you want to wait to vote on this until tomorrow morning?
I'm happy to vote on it now if that's the committee's preference.
I'm
good.
Yeah. Vote on all of them tomorrow? Okay, great. Go ahead. Lovely stack in the morning. We had so much fun together.
Okay.
Okay, thank you. We have one more bill, guys. Sorry. We have not had very many late nights around here, though. This is the first one, right? Okay. And this is the best bill that's been in the building the entire session that we're about to talk about. Yeah, it's a super hit, Abby. Come on, I know it's your favorite bill to buy anything too.
The Colchester Fire District is coming back?
Today.
Eford.
So, this is, do I need to introduce myself again for the record? I don't.
Actually, don't know the rule.
Don't know. Abby Shepherd, Office of Legislative Counsel. I don't know. I should probably find that out. I am going to share my screen and pull up the side-by-sides. Sorry, this is H480. This is the property valuation and reappraisals bill. I can refresh your memory.
Maybe you are done.
I'm waiting to talk to Abby.
Oh, okay, cool.
So,
Okay,
yep. That's okay.
you're welcome to stay here as long as you want.
Or I can come find you. So this, you have the as passed by House on the left, and again, this has not been updated to show the as passed Senate version, but everything that's on the right in this side by side shows what was just passed out of the Senate. The majority of the amendments were from the Senate Government Operations Committee, and then there are two very small amendments that I can point out as we go along that come from the Senate Finance Committee. So really everything on the right is what just passed out of the Senate. But just to give you an overarching refresher on what passed out of the House in H480, this is the bill where in 2023, the House repealed the trigger for a reappraisal based on the CLA. It was made retroactive to Grand List Lodge April 1st of 2022. It required two different dates for reporting from the Vermont Department of Taxes on an implementation proposal to actually implement a state reappraisal program, also recommending new categories of property. This committee had done a lot of work on looking at different types of property and how they might be categorized. So that you ended up with two bills being sort of combined into this bill. So there would be a progress report next December of this year, 2023, and then a very detailed implementation plan in December 2024. The bill as passed out of the House did amend statute to sort of create the structure for a statewide reappraisal system. So the House version did take action if that had passed both bodies that would have created the statewide reappraisal program effective in 2026. So it didn't implement it immediately. It required the study, and then the shift from municipalities reappraising to the state reappraising would have happened several years later. There were several funding changes in the House passed version. So there are two per parcel fees that the state pays to towns currently for reappraisals and for the equalization study. The reappraisal $8.50 per parcel fee was repealed in the bill. And then that $1 equalization fee was increased to $2, and the revenue, so $7.50 that would have been left over, would be paid to PVNR to implement and run a statewide reappraisal program. So that's the structure of your bill. There were also some education requirements, training requirements that were initially requested by the Department of Taxes, and some technical cleanup regarding education requirements that was in the bill. That's talked about a little bit less because it has a bit less of the momentum, but just to point out that was in the bill. So that was what passed out of the House. And now I will walk through the side by side. So the first section that was in the as passed by House version did include the findings, and it provided statistics and sources relating to appraisals, both for financing purposes and for reappraisals. That was struck. And it also laid out the current state of municipalities and the number of Vermont municipalities that have not reappraised in a very long time. So there were some statistics there, but that was deleted from the bill. Okay. The next section.
I've ever used findings in a bill in my whole life, but I am happy to have it got to. It's very funny.
I think actually what I might do rather than doing, so the side by side is almost instantly off kilter because of the two different bills and the way this came out of the Senate. The Senate no longer has the language automatically moving in 2026. reappraisals to the state. So everything that you're seeing after this is now sort of out of sync with what was passed out of the House. What is still in there and what is now the Senate version of Section 1 is what you passed out to repeal the CLA as a trigger for reappraisals. That is still in the bill. So it does retain the coefficient of dispersion. That's still a trigger for reappraisals. That's when there's a disparity between properties in the same town and the same grand list. That would still trigger a reappraisal. In Section 2 of the Senate version, the per parcel fees are no longer being changed in any way in the Senate version. What they're doing in Section 2 instead is creating a new reason why the state would be able to order a reappraisal, which is a sort of a stale reappraisal. It's requiring municipalities to reappraise every 6 years on a schedule to be set by the department by PVNR. So there is some discretion left to the director so that their schedule can be set. It does take effect January 1st of 2025 with the expectation that the department will have set a schedule by then, with the first reappraisals to be completed by 2027. So CLA is repealed and there's a 6-year sort of, in theory, rolling schedule that would be implemented instead.
No,
Okay. Yeah, Representative Andrews, thanks for reminding me that you were.
That's cool. So if we are leaving reappraisal with towns and requiring it to happen every 6 years, and we already know that it physically is not possible to do it every 10 years because there's not enough people to appraise, like, is this a strategy that we can back up?
I think that the way I sort of read the changes that they made is that they removed the sort of date certain on moving it away from the state, but there's still all this studying about the possibility of the state taking it over. And there was just a lot of discomfort from the field about the fact that we had a date certain for something we were still studying. We've talked about that on the floor.
Yeah.
Dozens of times in the last 2 days.
Yeah.
And so I think it was sort of a similar concern, and so they removed the date certain. But I think it's still a possibility if that fix is determined to be needed.
Thank you.
So is this that the state is going to force towns to do a reappraisal every year, 1/6 of their community?
Oh, that's interesting. It's in every 6 years, the town has to reappraise unless the director of PVNR approves otherwise. Within the study requirements, the department has to come back with a schedule, especially for that 6 years. So it doesn't presuppose, that is certainly one structure, but it doesn't require the department to choose. It's asking for recommendations about whether it would be that type of structure, 1/6, or would it be
The town's
some other form.
6 years until this report is done and 6 years out and then start.
Potentially, yes. So it would depend on the director's schedule.
And in the meantime, they get this $2 per parcel on the grand list.
It's $1. Sorry, the $2 was what the House would have increased it to. It's $1 for the equalization study, and then it's $8.50 for conducting grand list maintenance. Those fees are unchanged in the Senate version.
Oh, I misunderstood you then.
Yes, sorry, the House version would have repealed the $8.50, increased the $1 to $2, but the Senate removed the repeal of the fees, so the fees are still going to towns.
Okay.
Sorry, I might not have explained that very well.
It's late.
Yeah.
So now I do have a question. So you said that they would have to get permission if they couldn't do it. Is that the kind of thing that would have to come back to us, like, when it just can't get things done on time or whatever?
Currently, the draft language says it's a 6-year requirement unless approved otherwise by the director. So that gives the discretion to the director of PVNR.
But we don't see this, once this is in statute, we don't see this again. We don't help if there's a problem, we don't. That's it.
Well, there's also the study coming back. So you could certainly take action, you could require more, but in terms of the schedule, the way this is drafted currently, it leaves the discretion up to the Department of Taxes. It's Director of PVNR, but it's Department of Taxes.
So COLA has gone and the COD stays.
The CLA is exact, yes, the common level appraisal, yes. Also a yearly, yes, you did as well. So that is the same as in the House version.
What else has he done?
Okay, so those are the changes. There were appropriations. There was first the $50,000 appropriation to the department to contract with an expert to assist the department when doing their implementation proposal. Sorry, it says plan there, it should say proposal. There was also intent language about appropriating enough money to fund the department to take on statewide reappraisals. There's no longer the shift in statute, so there isn't that fiscal year 26 appropriation or intent to appropriate. Again, the language around requiring municipalities, requiring the state to conduct reappraisals, that's been removed from the bill. Let's see. Yes, so the section 6 of the House version, that's where the statewide reappraisal program was being added into statute. So that's all been removed from the bill.
Gone.
The per parcel fee changes all removed from the bill. So towns will continue to receive per parcel fees. The changes to the study, so there's both the progress report at the end of this year and then the full implementation plan. It's now called an implementation proposal because it's not presupposing that the state will take over statewide reappraisals. They added a few other requirements from the department to report back on. So there are several different requirements regarding implicit bias training, options for reducing any materials that are provided by the department that may sort of infer implicit bias or include that in the training materials from the department. Again, because there is this new requirement that towns will be reappraising every 6 years or being ordered to reappraise, the progress report in December of this year, again, requires the department to have a preliminary schedule for how towns will be phased into this 6-year reappraisal requirement. So that could be a recommendation to reappraise parts of towns every year over a 6-year period. It could be looking at different geographical locations of which towns would be reappraised and when.
It'd be like every ski town in the state gets reappraised the same year, for instance.
Perhaps it might also be based on just time since the last reappraisal, since some towns have gone a decade or longer. It also in that report, there is so a lot of the language changes had to do with both implementation proposal instead of a plan, but also how the request for data on properties was being characterized. So rather than using property categories, which was most of the discussion here, the department clarified that to them, when talking about property categories, that means what's used for the equalization study. So instead, property types and characteristics is used in this report, and it expands on what the department is reporting back on. So property types and characteristics, including use, occupancy or vacancy, square footage, any other relevant factors. A lot of the data reporting requirements were also sort of expanded with some more housing related data points being required. And then lastly, this is bolded and some of this underlined here and italics is just to note this was what was added by the Senate Finance Committee. So this is coming out of the Senate. There is now also at the end of this year a requirement for the department to report back on considerations and recommendations for changing the annual date when the grand list is lodged. It's currently required to be lodged on April 1st, so moving it to January 1st or another date. And that maybe concerns about when the appeals process concludes and when grand list data is actually set in the grand list, how that might impact property taxpayer decisions as well, because they will know what their value is by the time of voting. So that is the first progress report. I did not list out everything that was amended in the much longer December 15th study, but the highlights are everything that was in your as passed House version is still in the requirement from the department in 2024, but there are more data points that are being required, and those are more specific to housing. Additionally, that the department needs to review its guidance documents for instances of implicit bias. So there's a focus there. But nothing was taken out that you had passed.
Love
Here, here.
it. Just add.
Last year's state appraisal and litigation assistance program, that will still take effect July 1st. There's no contingency. That said, the budget does have appropriation to fund that program. So that is the same as what passed out of the House. The lister and appraiser education, so I'll just pause. That is the end of the reappraisal and the property types and characteristics aspect of the bill. The next few sections are very technical. I don't know how much detail you want me to get into, but they did make some changes here.
So the money's gone, but the requirement of creating a certification program for listers, et cetera, is there.
Oh, so the money, the $100,000, that's a purely technical change. It was repealed from the reappraisal section and put into the assessment education section. So
Okay, so it's
an
still
existing
there.
appropriation, it's still there. It's
Thank
just
you.
shifted in statute. So what the Senate change was to require the director of PVNR to include training for listers and assessors relating to trying to promote bias reduction.
Yeah.
What maybe has also has another impact on listers is that they changed, so in the House version, you had required elected listers to meet the same qualifications and requirements as hired assessors. Under current statute, only one lister out of the 3 per town has to go to PVNR trainings. The as passed House version will require all listers to meet the same training and requirements for assessors. The Senate added in sort of this buffer period so that if an elected official at the time of being elected does not meet those requirements, they have 1 year to take training programs. And it's also effective in 2026. So for those who are currently in an office of lister, they would have time as well to get up to date. The other technical changes, many of these did originate with the Department of Taxes. Those are also unchanged. So it's notice to PVNR when a town votes to have a hired assessor instead of listers. And it also allows towns to vote to remove the office of lister at a special meeting.
That's kind of a change though.
That's not a change. So that is what came out of the House. That was not changed in the Senate. Okay. And then that is the extent of the changes. And I can remind you about dates if that's helpful, or just the really important date there is that the repeal of the CLA as a trigger for reappraisals is retroactive to April 1st of last year, which is what passed out of the House as well. So that's still there.
Lines are still there. That's good.
Yeah, the movement forward is what is still there.
Yeah.
Feels really good.
Totally.
And
Can I also
taxes.
just say, like, adding training on racial disparities into the training for listers and assessors, I thought was really astute, so I was really happy to see that.
Yeah, moving forward, right, we're still moving forward in a sensible way. I had some pushback from one set of listeners concerned, I guess, to simplify what they were saying was moving too fast here. We don't know what's happening and we're freaked out, maybe that was inappropriate, but anyway. And this, I would describe the back and forth between House and Senate is in general terms a good choice of pieces from here and there that will calm the waters, I think, considerably in a lot of listers and towns. So on balance, this is fine. I'm happy. It's okay. I'm happy with it. Go for it.
And I think this has been a really great project with Department of Taxes, who have been really really support what I did a lot of work within on the Senate side,
Good
to make sure I got across the finish line over there.
You need action on this one?
We do need to vote to concur, but let's just do that tomorrow too, so that we have like a, what's it called, a hat trick?
Tetra.
You're so sporty. I got all the sports in. Great, okay. Thanks. Okay, so we're done for the day. We'll see you at 9 a.m. tomorrow. Please be on time because we're gonna be voting on all.
Nine? Okay.
You're 9.
We're getting to the last of these.
Oh, I think maybe we're caucusing at 9. Okay, 8:30, we're all here at 8:30 tomorrow morning.
Almost there.
If you don't, sorry, one more thing, guys, we're still alive. Can everyone just?
Gray and then.
Okay, we're live. Good, we're still live and hearing and stuff. So I think, there are caucuses happening at 9 that some of us need to be at. So let's be here at 8:30. We need to be on time at 8:30 because we have 4 votes to make at 8:30. And so if anyone has anything that they need to think about between now and 8:30, think about it before 8:30, please.